Howdy, Jacob here. Today we're looking at Fabrinet in the electronic equipment, instruments, and components industry. 7.6 billion market cap, almost a billion less enterprise value. So likely holding a lot of cash here, net cash here. Founded in 1999, they provide optical packaging and precision optical, electrical, mechanical, and electronic manufacturing services globally. Their revenue growth is very impressive, going up over 3 times, almost 4 times in the last 10 years. So it looks like they had a tough 2018, and outside of that, been growing double digits, heavy. Um, Increase of gross margin and operating margin. I do like that, but I don't like how low they are. So sub 10% operating margin, sub 15% gross margin. Not the most sexy margins there, but again, them increasing is definitely something that I like. So bottom line is increasing more than top line. Companies are being more efficient. Return on invested capital is increasing. All positive things. No R&D because cost of goods sold is a hefty amount. So just the products it takes to create what they sell, and then sales generated them in a tiny bit. They have a little less than a billion, about $800 million in cash-like products with no short-term debt, no long-term debt, less than that in their total liabilities. So total liabilities is less than 600 million. They have over 800 million in cash-like products. So that is crazy wonderful. Their cash flow statement shows a massive increase of cash from operations and CapEx relatively flat. They reinvest a little bit, they buy back shares a little bit, and they've bought down debt or paid down debt a little bit. So majority of their money is going to reinvesting and share repurchases. That is about as good as it gets. Buying back shares when they are truly cheap and reinvesting to get these historical, very solid double-digit teen returns. That's very positive, and I'm going to take that into consideration as I make some assumptions here. So for revenue growth, I feel like 10% a year seems pretty reasonable when they can just reinvest as much as they can. Um, their margins are going up, so historically averaged about 8 and 7%, but I feel pretty good about putting maybe, let's do 11 and 10% for share change. Again, that's going to be tough because their gross margin is pretty high. But again, the more you make on the top line, even with cost of goods sold being what it is, you can get as close to that gross margin as possible. So I think that, maybe that's going to be really tough to get anything more out of it. Uh, but I still think at the end of 7 years, still feeling pretty comfortable with that. For share change, 1% for them is about $80 million. They're just really offsetting stock-based compensation right here. And their P, price to free cash flow, probably a 20 is what I'm looking for. So again, that's because they have so much cash on hand. They have over 10% of their market cap in cash, essentially. And so in net cash. So that's money that they can immediately buy back shares with, pay a dividend with. If they are very solid with that capital, it can be immense for you as a shareholder. And their growth rate's very solid. The only thing that I think is dampening their terminal P and price free cash flow is definitely going to be that margin, but still something I feel comfortable with. And we're saying it needs to fall 41% to get to the return we look for here. Fantastic company. I would love to own this. I think it's going to grow pretty hefty. I think, those increasing margins are amazing. I think that they're reinvesting and buying back shares. Hopefully they're buying back shares when it makes sense, but when they're just offsetting their stock-based compensation, pretty fine to just dollar cost average into a great company. So yeah, dropping 41% before you get the return look for here. I hope it falls there. I hope it falls more and I can do a deeper dive and make sure these numbers are appropriate and then maybe get on it. So I hope you enjoy this video and have a great rest of your day.